Good morning and welcome to the Saxo Bank Morning Call. It is Thursday, May 2nd, 2019, and here we are the morning after the FOMC meeting late last night. A pretty interesting one, mostly from the market reaction. I think the developments were actually a bit fewer than some of the headlines, suggesting that interest on the excess reserve cut was partially expected, partially not expected, but they went ahead and did the 5 basis point cut, getting more control over the rate there. That's not really a big market impactor, but what wasn't a market impactor was this perceived difference in the statement versus the press conference from Powell. And we have a chart here of the Fed funds future for December. So you can see there that bar last night stretching about 5 basis points more in favor of cutting before the press conference, at which Powell seemed to be a bit more dismissive of inflation, and it came all the way back down about, currently now about 10 basis points below where we were at the height of that reaction to the statement itself. So a pretty interesting reaction there. If you look at the statement changes here, I've got some of these highlighted. A bit hard to maybe see this on the graphic, but basically partially complementing the rate of economic activity, but also pointing out that household spending and business fixed investment did slow in the first quarter. And then it was this bit about inflation has declined and is running below 2%. That was what set the dollar on edge, weaker, and saw the market more aggressively pricing those rate cuts. And then again, Powell came out at the press conference and was saying, "Oh, these are transitory factors. We're neither in favor of a cut or a hike at this point, and we're comfortable with the current rate." And that was taken as hawkish. I think this is a lot of over-eagerness to interpret, and I think the market was simply very leaning towards a very dovish outcome that simply wasn't there. So that's where we are. And of course, with the yield curve reaction, I'll say we see the yield curve flattening again. It was trying to steepen a bit. I think it was up as the 210 was up as something like 24 basis points, but it's gotten crushed back lower on this.
Yeah, exactly. And the main reason is just because of the surprise that we had yesterday with Powell's statement. As a matter of fact, the biggest volatility in treasuries has been seen in 2 years yields. The 2 years yields, as the Fed, as Powell started to speak, started to drop from 2.26% to 2.21%. And then as he was speaking about inflation, the 2 years yield basically rose by 10 basis points. We have a graph here that shows the yield curve, and although there has been a steepening in the past few weeks, it cannot be said that the yield curve is steeper compared to the past. As a matter of fact, it is the flattest we have seen since 2008. And I believe that at this point...
So you've chosen, for the red, you've chosen the 10-year, 6-month, and the blue line being the 5.2s.
Yeah, I believe that it's important to focus on at this point on the 2 years yield, and the reason being is that the steepening that we have seen before yesterday has been caused by a rally in the 2 years treasuries. But now that Powell said that he's not going to cut interest rates and is going to keep interest rates on hold, then the bond market will need to shift their attention from the 2 years to longer maturities. And at this point, once that investors are going to be positioned on longer maturities, then we might as well see an inversion of the yield curve, because of course the longer part of the curve might then reach the same point or even a point below the 2 years yields.
Okay. So some interesting thoughts on the yield curve there. If we look at the dollar reaction, we saw pretty much a carbon copy of what we saw on the interest rate futures for the Fed. We saw the dollar weaker, and Eurodollar had poked above that 112 again, and then the rally yesterday essentially neutralized. But it's real limbo here. We've rejected the downside breakout, but is this the rejection of the rejection, or what are we supposed to think of this here? In any case, it does put a cap on Eurodollar for now, and it'd be interesting to see if it can work back well below 112 again and put back that downside into motion. Aussie dollar as well, resting near that 70 big support level for that pair. We have an RBA next Tuesday, about 50-50, and maybe slightly less than that in favor of a cut, and that should be pretty pivotal there. But as well, there's the whole issue of the Chinese renminbi holding back volatility. On that front, we do seem to be getting a more accelerated timeline. Some pressure, at least in the press and from announcements, PR-wise, from the U.S. administration that they're getting, want this thing to wind down. Maybe something next week is about as good as we can see from the latest headlines. And Ola, I mean, U.S.-China trade deal. We got to talk about commodities. So that's a big factor there.
Absolutely, and I think also just we're looking at what happened yesterday, where we see the yield curve flattening once again, and it again potentially raised the worries about the recession, even though that has faded somewhat. But just take a look at this chart here, because there's something is really happening here, and because you can see this is showing the blue line, the S&P, which is just hovering close to these record highs, and the brown area is the Bloomberg Commodity Industrial Metal Index, seeing quite a significant divergence between those two now over the past month here during April, and that accelerated yesterday when we saw quite a bit of a dip in copper. So this market is clearly telling us that we've had some manufacturing PMIs both from China and US this week on the weaker side, and the commodity market is taking note, but the stock market so far has managed to ignore it.
There's a South Korean PMI overnight. This is a very short history. It's a Nikkei, I think, that runs this PMI, and it did show another bounce, but it's at 50.2. So we're not talking about
still just hovering around
but it is an improvement, at least from the sub 50 levels the previous couple of months.
And it basically means that if you look at the copper in particular, it's on the chart here. It has really taken quite a bit of a beating. I think it was the biggest sell-off since last August. Well, it returned to it's a big sell-off since last August, and we're now really focusing once again on the 277 level, where we bounced back in February. It's the 50% retracement of the rally we had from January up until recently. So that one caught the market by surprise. So manufacturing on one side in terms of supply, in terms of demand, and also just some stories about a mine in Chile reopening, and that's just adding some short-term press to the market.
Right, and then the oil market, we have some interesting, very unusual bit of news here. Yeah. About Russian oil coming into Europe being contaminated. Yeah,
it's been hovering around the market now for the past week. But initially, the Russians were quick to say they could be solved fairly quickly. But it seems like it's going to be an extended problem. Basically, Transneft, which controls pipelines, which can circumvent the world twice, basically are the major suppliers of crude oil through pipelines into Europe. And some contamination has occurred within the last couple of weeks, and it was discovered last week. And now the market is potentially could take weeks or even months before this is solved. So that potentially has creating some bottlenecks in Europe. So far, countries are digging into their reserves, especially Poland and Hungary. But take a look at the chart here, and I think it just basically adds to this tight supply story that has been supporting the market. Yesterday, two opposing news. In the bottom left corner, you can see inventories in the U.S. Continues to rise, so that added a little bit of price selling yesterday. But overall, this fact that we are seeing another potential source of supply disruption is going to keep the market supported in the short term. Just in the middle of the chart, there is basically a spread between the first and the 6 months Brent futures, and the higher that goes, the more it reflects tightening in the spot market, and this could be the one to keep an eye on.
So 6-month forward crude is $3 cheaper.
Yes.
Wow, that's quite a bit of backwardation in the market then.
It is indeed.
Okay. Good stuff. Equity market takeaway was generally that the Fed being less dovish than hoped for. There, of course, the whole big Fed turnaround is one of the key things driving equity markets higher. That sort of a lack of dovishness seen as bearish for equities. It's a one-off reaction, but it is happening around these all-time highs in the U.S. So interesting to watch there if there's a further add-on or momentum in this pessimism off the back of this FOMC meeting. And I'll say in credit spreads, we've been seeing, since the December blow-up, we've just been seeing tightening credit spreads. A lot of complacency in corporate credit.
Yes, we have a graph here that shows actually high yield in orange and investment grade corporate spreads in blue. And as you can see, there has been a very good tightening since the beginning of the year until now. And after the Fed meeting yesterday, I believe that this tightening is going to be supported throughout all the year. And in the previous calls, we have talked about how to take advantage of these, and we focused on short-term maturities. But as I mentioned before, now that the attention is going to be shifted towards longer dated maturity, I believe that investors should start to take into considerations corporate that have a maturity between 7 and 10 years in order to take advantage of higher yields and possibly to ride a tightening later on in the year if Powell is going to cut interest rates.
Yeah, which we do think he is going to do. I think this meeting was just sort of a putting your foot down and saying we don't want to say anything yet. I think they will be saying something at upcoming meetings, possibly after their through this review of their monetary policy mix, and that could take a little bit more time. There's an interesting conference coming up in early June, we mentioned. Bookmarked out, and we'll of course be talking about it if any news emerges from that ahead of the June FOMC meeting. But for now, back to today and this week. Let's look at our economic calendar for the today and the rest of the week. We have the final version of the Eurozone April manufacturing PMIs. If I recall, these showed a modest bounce from the March levels. A Bank of England meeting, which I think you have a hard time seeing them sending dramatic new messages when you have the political situation and over Brexit mired in complete chaos. The Czech Central Bank expected to hike rates to 2%. That's an interesting one there. Carney press conference at 11:30 GMT, and then I think the U.S. weekly initial jobless claims could be getting interesting in coming weeks. We've seen a couple of record lows recently, and now we've seen an enormous bounce off those lows. This is the earliest indicator on the jobs market, so it's the weekly moving average, if you will, that we should be tracking for any sense of a weakness coming into the U.S. jobs market. And then the rest of the week, I think as well, we did see this big dip in the ISM manufacturing. I think some of that could be this inventory overhang effects from all the disruption or late in the year and piling into piling up inventories over concerns about a aggravation of the U.S.-China trade relationship. The ISM non-manufacturing to me is more important, and we saw a dip there last time around. What is the quality of that number? That is up tomorrow, together with all the latest U.S. Jobs and earnings data. So I think tomorrow could be quite interesting for establishing where we are in the economy to a degree, and where we are on the dollar after this somewhat confusing FOMC announcement yesterday. That's it for today. We'll be back tomorrow with the Saxo Bank Morning Call. Thanks for joining.